Thanks for clicking. The Bank of Canada's next move on interest rates will be a cut. This according to a number of economists following Canada's lower than expected inflation data on Tuesday. This notion was echoed by CIBC's Benjamin Tal at the annual Mortgage Professionals Conference, where Tal noted that if rates are still high in 2025 and 2026 when the Covid Cohort comes up for renewal, it's not going to be pretty.
Somebody has to do something.
But can we expect to see interest rate cuts by mid-2024? Given that the last time Canada saw non-emergency rate cuts was in 2015, I think it's worth looking at what the economy usually looks like when the bank loosens policy. So what I want to do today is go over why so many are predicting cuts.
Because I got no place else to go.
Nope, not just that. Today I want to discuss why so many think the bank's next move will be a rate cut, go over the economic conditions that Canada had the last time we saw interest rates go lower, discuss Benjamin Tal's prediction that the bank will lower rates to save real estate, and then discuss what to look for next. Speaking of next, the Bank of Canada is set to make its interest rate decision next week on October 25th, and we'll obviously have an update out on that decision on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these cuts. Onto the rate cuts. The first reason for the cut, the economy. Benjamin Reitz of BMO Economics said that with the economy weakening and inflation trending down, there should be no more need to hike rates. Indeed, Canada's unemployment rate is sitting at 5.5%, well above the 4.9% that we had 6 or 7 months ago. So the bank's hikes are working. They are causing unemployment. This was echoed by David Rosenberg, who said that with inflationary pressures and recession in the offing, the bank should begin to weigh the risks of staying too high for too long. And, in addition to the economy, Capital Economics stressed the downward path that we've seen on inflation, noting that with inflation moving closer to target, the next move by the Bank of Canada is likely to be a cut. And that is sort of the case, with headline inflation dropping from 5.9 in January down to 3.8 last month, albeit with fits and starts, and core inflation measures also down since January, again, albeit with fits and starts. So we have the economy and inflation putting pressure on the Bank of Canada to lower rates next year, and CIBC's Benjamin Tal says that real estate will also be on the bank's mind.
Do you miss me?
Tal, for his part, in effect, said that real estate runs the show, saying that if rates aren't lower by the time the COVID cohort comes up for renewal in 2025 and 2026, it's not going to be pretty. Tal shared a similar sentiment in June of this year, noting that we all know what happens in 2025. So, in the wake of weak inflation data, we have multiple predictions coming of rate cuts in the next couple of quarters due to a weak economy, slowing inflation, and the real estate market. So, let's take a look at the last time that we had rate cuts, the last time that we had non-emergency rate cuts, and see what the economy and inflation looked like back then. I do want to briefly note that finding data points for rate cuts over the past 15 years isn't exactly easy. Rates have been so low for the past decade and a half that we've only seen 2 instances of non-emergency rate cuts in 15 years.
How could this happen?
Regardless, what did Canada's economy look like in January of 2015, the last time we had a non-emergency rate cut? When the bank made its decision to lower rates down to 3/4 points in January of 2015, the unemployment rate was sitting at 6.6%. The bank then lowered rates again in July of 2015, citing low economic growth and downward pressure on inflation. At that point, the unemployment rate was sitting at 6.8. So, in both instances of rate cuts, the unemployment rate was much, much higher than it is right now. 1.1 to 1.3% higher than we currently have. Also worth noting, the last time before that we had non-emergency rate cuts was between 2003 and 2004, during which all of that time the unemployment rate was well above 7%. But the Bank of Canada doesn't just look at employment when it's considering rate cuts. Obviously, it also looks at inflation, as in how restrictive or stimulative are current rates. If we look back to December of 2014, the prime rate was sitting at 3% and the inflation rate was sitting at 0.97. So prime was about 2% higher than the rate of inflation. Then, in June, when the bank lowered rates again, prime was sitting at 2.85 and inflation was at 1.03. Again, prime was about 2 points higher than the rate of inflation. In fact, if we look at all years between 2000 and 2020, the spread between prime and the inflation rate has always been about 2%, with the average for all years between 1960 and now being 3.31. Regardless, The spread between the prime rate and the inflation rate the last time that we saw non-emergency cuts was about 2%, compared with the 3.4 right now. But, and here is the important part, the bank back then was trying to stimulate inflation. It was trying to get the inflation rate back up to 2%. So that 2% spread was considered stimulative. We didn't have enough inflation in 2015, the last time the bank lowered rates. Contrast that with a year from now, or even 9 months from now. When Q3 starts in 2024, is the inflation rate going to be on a sustainable trend back down to 2%? I don't know, and nobody else does either. Over the past 3 months, prices are up about a quarter point. Annualized, that would be 1% inflation in a year from now. However, over the past 6 months, prices are up 2%. Annualized, in a year from now, we'd be at 4% inflation. Given that, in addition to high inflation expectations and high wage growth, not to mention a great big black swan event that could unfold in any number of ways and could result in prices going higher in any number of ways, I'm not sure that anyone can make a definitive prediction as to where inflation will be in 6 or 9 months from now.
That's never stopped us before.
So, the last time that we had non-emergency rate cuts, inflation was at 1% and had been for a very long time. Right now, inflation is at 3.8, and it's anyone's guess as to where it's going. With that said, the unemployment rate right now is sitting at 5.5. The last time we got cuts, it was sitting at 6.6, 6.8. So the unemployment rate still has a long way to go before the conditions match those of 2015. But the main point, though, the main takeaway is that as it stands right now, the economy in 2023 and 2024 looks as though it's a long way off from where it was in 2015. The last time we saw non-emergency cuts. But what about real estate? CIBC's Benjamin Tal says that we are lucky that we have enough time between 2025 and 2026 to get rates low enough in time for those COVID renewals.
Isn't that a lucky break?
Oh, yeah, very lucky.
The argument being made by Tal is that if interest rates aren't back down to say 3% by 2025, 2026, the economy could be in real trouble, as all those mortgages that were taken out, those ultra-high mortgages during the pandemic, will be coming up for renewal. But is that what the data says? When the ultra-low interest rates came out in March of 2020, according to CMHC, about 45% of new mortgages were that of fixed rates. This remained the case until April of 2021, about 1 year later, when those taking 5-year fixed rates stopped and the number of people taking variables shot right up. In fact, 5-year fixed rate usage was at its highest level in September and October of 2020, back when the average price of a home was $605,000. A decent 5-year fixed rate at that time was 2.22, and that would have given an average mortgage payment of $2,472. If those same buyers were to renew right now at a decent rate of 5.89, that payment would shoot up to $3,401, so about $1,000 more per month. So that's those fixed rates that are renewing in 2025. What about 2026? At the end of 2026, the average price was $710K, and a 5-year fixed was 2.94, resulting in a payment of $2,882. If those same borrowers tried to renew 5 years later in 2026 and rates are where they are right now at 5.89, that payment would jump up to $3,965, or about $1,100 more per month. So, fixed rate payments, on average, obviously there will be outliers to one extreme or another, but on average, like we saw, up about $1,000 at the time of renewal in 2025 and 2026. Are those payment shocks enough to induce the bank to lower rates ahead of time? I can't say for sure, but variable rate holders have been dealing with much more significant increases over the past year and a half, and that has yet to induce the bank to lower rates prematurely. With that said, Tal could be referencing those holders of variable rate mortgages with fixed payments. Those mortgages which compose 1/5 of CIBC's book. See, fixed rate mortgages coming up for renewal have one great big thing going for them. They've been paying down principal and a lot of it. Those holders of variable rate mortgages with fixed payments really haven't, unless they've made additional lump sum payments or increased their payments, so they'll have a much larger balance spread over that 20-year renewal. So, when Tal says that we're lucky that we have enough time for the bank to lower rates so we don't have a renewal crisis in 2025 and 2026, it's not clear that he's talking about fixed rate holders as their payments are set to go up by even less than we've already seen holders of variable rate mortgages have their payments go up. I can't see how we'd be talking about variable rate mortgage holders, as they've already been making their payments. They've been seeing their payments rise every time the bank raises prime, so they won't really be seeing anything different. Therefore, I can only conclude that he must be talking about the mortgages that are on CIBC's books, that were lucky enough that the bank can prematurely lower rates in time to save CIBC's books. Regardless, the message of the day coming out of the news outlets is that the next move by the Bank of Canada will be rate cuts, with Tal saying by mid-2024. With that said, when we compare the economy that we have right now with that of 2015, the last time we saw non-emergency rate cuts, things are a lot different. Unemployment was much higher and inflation was much lower the last time the bank was able to loosen its policy. So if 2015 is any guide, and we don't have that many guides available to us, but if 2015 is any guide, the unemployment rate is going to have to go higher in order for us to get those cuts. The inflation rate is going to have to go much lower in order for us to get those cuts. Whether or not real estate will present enough of a problem for the Bank of Canada that it will prematurely cut if we don't have low inflation. With that said, we will continue to track Canada's economy and the Bank of Canada's attempt to guide it on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.